What's up everybody, it's Sahithi and welcome back to my channel. Now, if you're anything like me, you're obsessed with finding those hidden gems in the market. Those little signals that scream buy before everyone else catches on. Well, today, we're going to unlock the secrets of candlestick patterns. These patterns are like roadmaps for traders, giving us clues about where the market might be heading. Whether you're a seasoned trader or just starting out, understanding these patterns can give you a serious edge in the game. So, buckle up, grab your notebooks, and let's get ready to master candlestick patterns for trading success. Alright, let's kick things off with the hammer. Picture this, the market's been in a downtrend, everyone's freaking out, selling everything they can. Then boom, you see this little guy pop up on your chart. Now the hammer is a single candlestick and it gets its name because it looks like, well, a hammer. You've got this short body at the top like the head of the hammer, and this long lower shadow like the handle. That long lower shadow is key. It tells us that sellers tried to push the price down, but buyers stepped in and drove it back up. See, that long lower shadow? That's a sign of buying pressure. It's like the market's saying, hold on, we're not going down that easily. Now the color of the hammer's body isn't as important as the overall shape. A green hammer, where the close is higher than the open, is generally considered more bullish, but even a red hammer can signal a potential reversal if that lower shadow is long enough. Remember, we're looking for that strong rejection of lower prices. The hammer is all about spotting potential turning points in the market. Next up, we've got the inverted hammer. Now, this one looks like the hammer flipped on its head. You've got this small body at the bottom and a long upper shadow above it. Think of it like this. The market's been in a downtrend and then suddenly, buyers come in with a surge of optimism, driving the price way up. That long upper shadow, that's the buyers testing the waters, seeing how much resistance there is. Now, just like the hammer, the color of the inverted hammer's body isn't as crucial as the overall shape and that long upper shadow. A green inverted hammer is generally seen as more bullish, but a red one can still be a valid signal, especially if it's followed by strong buying volume. The key takeaway here is that the inverted hammer suggests indecision in the market, but with a bullish bias. Now let's talk about a two-candle pattern that screams bullish reversal, the bullish engulfing pattern. This one's pretty easy to spot. You're looking for a small bearish candle, usually red, followed by a large bullish candle, usually green, that completely engulfs the previous candle's body. This pattern typically occurs at the bottom of a downtrend and signals a strong shift in momentum from sellers to buyers. Think about it. The bears were in control, pushing the price down, but then the bulls came in with overwhelming force, completely erasing the previous day's losses. That's what makes the bullish engulfing pattern so powerful. It shows a decisive shift in control from sellers to buyers. Next up is the piercing pattern. This one's also a two-candle pattern, and it's all about breaking through resistance. Here's how it works. You've got a bearish candle, followed by a bullish candle that opens lower than the previous close, but then rallies to close above the midpoint of the first candle's body. Now this midpoint is important because it represents a key resistance level. The fact that the bulls were able to push the price above this level shows their strength and suggests that a trend reversal might be in play. The piercing pattern is like a mini battle between the bulls and the bears, and in this case, the bulls are winning. Now let's talk about a three-candle pattern that's a classic sign of a potential market bottom, the morning star. This pattern gets its name because it looks like a bright star emerging after a dark night. Here's the setup. You've got a long bearish candle followed by a small-bodied candle. It could be red or green that gaps down. This small candle is called a doji and represents indecision in the market. Then, you have a bullish candle that closes well above the midpoint of the first candle's body. The morning star pattern is a powerful signal of a potential trend reversal because it shows that the selling pressure is weakening and buyers are starting to regain control. Finally, let's wrap things up with a pattern that signals strong, bullish momentum. The three white soldiers. Pretty self-explanatory. You're looking for three consecutive bullish candles, each with a higher close than the previous one. These candles should have small or non-existent lower shadows. Full control. The three white soldiers pattern typically occurs after a period of consolidation or a downtrend, and suggests that the bulls are back in charge and ready to push the price higher. This pattern is the longer it continues, the stronger the bullish signal becomes. And there you have it. Master these bullish reversal patterns to enhance your trading strategy. Remember, these patterns are just one tool in your trading arsenal. It's crucial to combine them with other forms of analysis like technical indicators, fundamental analysis, and good old-fashioned risk management. Don't forget to backtest these patterns on historical data and paper trade before risking real money. The more you practice, the better you'll become at spotting these patterns and using them to your advantage in the market. And there you have it. Master these bullish reversal patterns to enhance your trading strategy. Don't forget to like, subscribe, and hit the bell icon for more trading tips and insights. Happy trading!